Ladies and gentlemen, thank you for standing by, and welcome to the Q4 2019 earnings release conference call. At this time, all participants are in a listen-only mode. After the speaker presentation, there will be an opportunity to ask questions by pressing star and 1 on your telephone keypad. I must also advise you the conference is being recorded today, Wednesday the 5th of February 2020. I would now like to hand over to your speaker today, Thomas Johnson. Please go ahead, sir.
Thank you very much, Summer, and welcome everybody to our fourth quarter 2019 earnings conference call and webcast presentation. And sorry about the slight delay here in the beginning. Here in Stockholm, we have our Chairman, President, and CEO, Jan Carlson, Chief Financial Officer, Mats Backman, and myself, Thomas Johnson, EVP Corporate Communications and IR. During today's call, Jan will comment on our current business highlights, our customer progress, and in particular about the very important unprecedented upcoming launch period for new technologies and customer programs we have ahead of us. Then Mats will walk you through our financial results, our efficiency programs, and provide some commentary on our outlook for the remainder of 2020. After this, we'll remain on the line for the Q&A session. And of course, the slides and earnings release are available through a link on the homepage of our corporate web page. So if we turn the page here, we have the safe harbor statement, which is an integrated part of this presentation, including the Q&A that follows here today. During the presentation, we will reference some non-US GAAP measures where reconciliations of the figures are disclosed in our quarterly press release and the 10-K that will be filed with the SEC. This call is intended to conclude at 2 p.m. CET, so please limit yourself to a maximum of 2 questions. That way we can work everybody's questions in. I will now turn it over to our CEO, Jan Carlson. So, Jan, please take over.
Thank you very much, Thomas. I would also like to say welcome everyone to today's earnings call. And by turning the page, I would like to start out our presentation today to reinforce the strategic direction of our company as we demonstrated at CES recently. Our focus is on collaborative driving, or as many like to reference, L2+ solutions. Our unique offering of state-of-the-art sensors and software suite along with our central compute capabilities provide both the system and subsystem solutions the market and our customers need. We believe that our total addressable market is not only the largest, but also the fastest growing market segment where we intend to evolve as a profitable market leader with our scalable architecture of sensors, software, and central compute. As we demonstrated at CES, our first L2+ system will be available in the market already during the first half of 2020, with more to come in the quarters thereafter. This is an important milestone and proof point for not only Veoneer, but also for the Zenuity software suite. Before moving on to our business highlights, I would like to pause and extend my sincere thank you to the entire Veoneer team for their great support, dedication in 2019, with a relentless focus on quality and at the same time driving strong operational improvements. Now, moving to the next page. Looking first to the underlying market conditions, we ended 2019 at a much lower light vehicle production levels than we expected at the beginning of last year. This was weighing on our 2019 results. Looking ahead into 2020, we expect the rate of light vehicle production deterioration to slow down. However, we foresee a continued weakness in the production environment, mostly in Europe and China, particularly in the first half of 2020. Looking at our market adjustment initiatives, we've made very good progress during 2019 in our VNE and balance sheet efficiency, and we intended to carry this momentum into 2020. We have now completed the divestiture of our VNBS joint venture, which generated approximately $170 million of net cash, and we continue to make progress with the strategic reviews of our remaining brake systems business and Zenuity joint venture. Our order book at the end of 2019 remained at around 19 billion, of which 80% is related to our electronic segment. This is despite the downward adjustment in the light vehicle production assumptions of approximately 9% for the period 2020 through 2025, and our lower than expected order intake in 2019. And lastly, as we enter 2020, our company faces an unprecedented period of upcoming new customer program and product launches with several important new technologies. It is expected that these launches are the long-awaited catalyst for Veoneer to return to organic sales growth during the second half of 2020 and ramp up and even accelerate into 2021 and 2022. Now looking on the next page. As alluded to earlier, we remain in the middle of an industry downturn where it appears that the global light vehicle production has still not reached a floor. We see approximately 50 million fewer vehicles, or close to 13% for the time period 2019 through 2022 since the spin-off of Veoneer. This is another 4 million fewer vehicles than we reported last quarter. The entire auto industry is affected by the limited light vehicle production growth through 2022 and continues to have an impact on our business and targets. For Veoneer, once our expected organic growth kicks in later this year, we foresee a sales growth for our company of close to 19% CAGR in 2022 from 2019. This expected organic sales growth is approximately 17 percentage points of growth above the light vehicle production market. And therefore, the focus for our company is about successful launches rather than the level of light vehicle production decline, while having effective cost control and cash flow management. Now looking on to our customer development in active safety on the next slide. We made solid progress in expanding our active safety product portfolio across our customer base. During 2019, we are pleased to have added our 7th vision customer, a monovision program with a major OEM, including sensor fusion features from the Zenuity software suite. In addition, during the year, we became technically qualified with 3 new vision customers. Looking to radars, we have added new business awards with 2 new customers and are now on the bid list with 20 customers. In all other active safety technologies, we expanded our presence as illustrated here on this chart. We estimate in 2019 that approximately 40% of our active safety order intake was for L2 plus systems, and around 45% of the active safety order intake included features from the Zenuity software suite. And lastly, as you have likely heard, earlier today we announced a new business award with our 8th vision customer. This system award includes our monovision camera and radars, along with the fusion software from Zenuity, which includes driver assist features like highway assist, lane centering control, stop and go adaptive cruise control, automatic emergency braking, traffic sign and light recognition, and automated high beam control. These are the important building blocks for higher level of automated driving. Looking now to our order intake on the next page. On this chart, we have recast our order intake trend to include only the electronic segment, which excludes the brake systems business. Our strong order intake in restraint control systems and active safety has resulted in approximately 15 billion order book. The vast majority of the order book is expected to be delivered during the period 2020 through 2026. Keep in mind, the market lead time of order to launch is generally in the range of 2 to 4 years. However, in our current situation, due to certain customer delays, we see closer to 4 years. As we mentioned before, our best estimate based on current market opportunities is for an order intake of approximately 1 billion of average annual sales for the electronic segment in 2020. This is 25% higher than our last 3 years average, as illustrated on this chart. Looking now onto our 2020 technology and customer launches. On the next page, we have summarized our key new technology launches during 2020. Already during the first quarter 2020, we will be launching our Generation 4 monovision camera system, our Generation 2 Smart ADAS ECU, and lastly, our much-awaited first launch of the Zenuity software suite for autonomous driving. These three technologies represent an important foundation for our expected future customer sourcing with both existing and new customers. During the second and third quarter, we will launch 4 additional camera technologies, including our thermal night vision Generation 4 technology, our first generation driver monitoring system, our Generation 4 stereo vision camera, as well as a customer stereo vision solution for an Asian-based OEM. In addition, we will launch our first standalone software feature with premium brand based in Europe during the third quarter. During the fourth quarter, we will launch our first SafeStop ECU module for a US-based robotaxi application and our 77 gigahertz 1.3 radar, which is a cost and performance improvement over the Generation 1.2, which we launched last fall. And lastly, we will launch our first roadscape high-definition mapping and precision positioning module with a US premium brand during the fourth quarter. Looking now to our specific customer launches on the next page. We have summarized here our top 15 new program launches, as well as the products and annual vehicle volumes, which are expected to each have more than 10 million of average annual sales. In aggregate, these vehicle models and platforms represent more than 500 million of average annual sales with a content per vehicle of $270, including brake system launches. The content of the top 15 is in the range of approximately $30 to more than $800 per vehicle. We expect these launches, as we have mentioned earlier, are more loaded to the second half of the year and should significantly contribute to our expected return to organic sales growth in 2020. Throughout the year, we will elaborate further on the specific customers and vehicle models as appropriate. This concludes now my formal remarks for today. I will turn the presentation over to our CFO, Mats. Please go ahead.
Thank you, Jan. 2019 was a very challenging and complex year for Veoneer, as we worked to implement capacity for the new program launches, as Jan just mentioned, but we also worked hard to improve our underlying cost structure. Looking now to the next slide. As we mentioned on our last earnings call, the macro environment and LVP situation continues to adversely affect our operating results in the near term. Our net sales for the fourth quarter of 456 million was slightly better than our expectations, while our operating loss was much better than expected, primarily due to our market adjustment initiatives around engineering reimbursements. Our operating cash flow was in line with our expectations, however, negatively affected by 30 million of timing effects, which we expect to normalize during the first quarter of 2020. Despite these timing effects, our net working capital improved by 39 million during 2019, and we remain very close to zero net working capital. We continue to see a positive development on our underlying cost structure, where the sequential improvement in the fourth quarter was 45 million when looking at the RD&E net and SG&A combined. When looking at the year-over-year development for the quarter, the improvement was 32 million for RD&E net and SG&A combined. Our company continues to be in the middle of a tremendous investment period to support the ramp-up of our future sales growth, supported by a strong order book. These investments for capacity increases in all major regions resulted in a capital expenditure for the quarter of 45 million, or 10% in relation to sales. Looking into further details for the quarter on the next slide. Our sales decline of 79 million as compared to the same quarter last year was due to a negative currency translation effect of 1% or 5 million, and an organic sales decline of 14% or 74 million. The organic sales decline was mainly driven by active safety of 39 million and restraint control systems of 27, while brake systems declined by 8 million. Within active safety, the continued negative radar product mix shift from 24 to 77 gigahertz technology and the gradual phase out of the monovision systems at BMW were the main drivers. The restraint control decline was mainly due to the phase out of certain vehicle models, primarily in North America, while the decline in brake systems was mainly driven by lower volumes on certain Honda models in China. The gross profit decline of 33 million for the quarter versus prior year was due to the volume and product mix impact caused by the organic sales decline, and the net currency effect was minimal. Our VNE net of 103 million decreased by 29 million during the quarter as compared to 2018, mainly due to the improved engineering reimbursement mentioned earlier. In addition, SG&A improved 3 million year-over-year due to lower consultancy and IT costs. We are pleased that during 2019 our market adjustment initiatives are driving underlying cost structure improvements in our company. Our VNE net for the full year 2019 was 562 million, which is 70 million below the first half of 2019 annual run rate, while the SG&A annual run rate improved by 30 million when comparing the second half 2019 with the first half run rate. Lastly, our operating cash flow for the fourth quarter was below prior year, mainly due to the timing effects in the working capital mentioned earlier, and other nets, which is mostly related to some favorable adjustment to deferred tax and assets and long-term liabilities in 2018. Looking now to our sequential performance on the next slide. Our sales decline of 6 million as compared to the third quarter was due to a decline in organic sales, as the currency translation effect was minimal. Restraint control systems and brake systems improved sequentially by 12 and 7 million respectively, while active safety declined 25 million due to the radar and vision mix issues mentioned earlier. The gross profit improvement of 3 million was mainly due to a product and a customer mix impact. RD&E net and SG&A decreased by 41 million and 4 million respectively as compared to the third quarter, and that is due to our market adjustment initiative. As a consequence, the lower operating loss improved our operating cash flow, which was offset by the net working capital change. As mentioned on our last earnings call, we believe the capital expenditure of 59 million last quarter was at the peak level, where we had a decline of 14 million sequentially in the fourth quarter. Looking now to our 2019 launches on the next slide. We have summarized the 2019 key new program launches and model facelifts. Although some of these launches didn't materially contribute to our organic sales development in 2019, they provide a strong base for our 2020 growth, in addition to the 2020 launches Jan highlighted earlier. Looking now to our 2020 outlook on the next slide. We have based our 2020 outlook excluding the VNBS joint venture in Asia operations, since we completed divestiture on February the 3rd, 2020. Our current customer call-offs and deliveries point to a weak first quarter, mostly in China and Europe, both sequentially from the previous quarter and year-over-year. This leads us to an expected global LVP decline for the first half 20 as compared to 2019. As a consequence, we estimate the LVP decline in the low single digits for the full year 20 as compared to 2019. For full year 20, Veoneer expects to return to organic sales growth in the mid-single digits. This expected sales growth is driven by new program launches, mostly in active safety and brake systems, during the second half of the year. During the first half of 2020, our net sales are expected to remain relatively flat sequentially from the second half of 2019, and the ramp up sequentially during the second half of 2020. We expect the currency translation impact to be minimal in 2020 versus last year. During 2020, our market adjustment initiatives are expected to generate further cost structure and balance sheet improvements. During 2020, we expect RD&E net, along with our operating loss and cash flow before financing activities, to improve from 2019 levels on a comparable basis, although most of the improvement is expected during the second half of 2020. I will now turn the call back over to Jan.
Thank you, Mats. Turning the page again, this concludes our formal comments for today's earnings call. But before we open up for Q&A, I would like to make a few comments regarding the unfortunate coronavirus. We are currently monitoring this and taking appropriate actions on a daily basis related to the effects from the coronavirus outbreak in China. And as always, the health and safety of our employees is our primary focus. To date, we are not aware of any cases of the virus with our employees. However, it's too early to assess the effects onto our China business, as this is an ongoing and evolving situation. By saying that, I would like to turn the call back to our operator, Summer. Please take over the call.
Thank you, Jan. Ladies and gentlemen, we'll now begin the question and answer session. To ask a question, please press star and 1 on your telephone keypad. And if you wish to cancel, please press the hash key. Once again, that's star and 1 to ask a question. We will take our first question, and this comes from Hampus Engellau from Handelsbanken. Please go ahead.
Thank you very much. 2 questions from me. Firstly, if you could maybe discuss a little bit on where you are in the modularization of your product offering and where we should start to see effect from that on the cost side. Secondly, I have a question on the orders. You are guiding for orders from 1 billion. I was wondering how much of that is orders that was pushed out from 2019 into 2020, and how should we think about launch cost in the second half of 2020? Thank you.
So let's start with the second part here. We said that a majority of the gap between what we earlier communicated and the 550 was a delay of that. If we look to the situation as of right now, you can say that half or approximately a little more than half of that push out is still up for grabs, so it's still out there for being awarded of the delay that we referred to. We have captured as of today around $100 million in order intake, and more than half of that is actually coming from new business. So around a half or more, slightly more than half is coming from new business that was planned this year. So that is the information we can give you now. It is a good start to be able to get around 100 million, a little more than a month into the year. If you then take the modular situation, this is something that we have been talking about, and it has taken a big step already when it comes to marketing this to our customers. We expect to, of course, look into potential order wins on this design or this concept, or maybe already this year. The financial effect out of it will kick in, of course, later. So that is nothing that we will see as of today, or as of 2020.
Thank you.
Thank you. We'll now take our next question from the line of Brian Johnson from Barclays.
Hi, thank you for taking the question. Want to start just kind of understand both the RD&E, but the performance in 4Q as well as the guide for year over year. And what would be helpful is to maybe just at least size up the buckets, love real numbers. So how much of the reduction, both in 4Q and has a change in 20, was due to commercial reimbursements? How much was due to perhaps rationalizing the R&D efforts and working on greater IP sharing across project teams? How much was just pace of launch activity? and how much was maybe just you cutting deeper than maybe you'd like to?
Maybe we can start. This is Mats. Maybe we can start with the guidance when we're looking into 2020, where we are talking about the lower RD&E in RD&E net in absolute numbers compared to 2019, which is the starting point. Looking into the fourth quarter in terms of savings and what we have seen sequentially in 2019, we have, as we showed in the second quarter and third quarter and into the fourth quarter, we have reduced RD&E, and we have reduced the run rate when it comes to our gross RD&E. So the reduction in terms of the run rate cost on the gross side is contributing to those savings. However, looking in the fourth quarter and from a seasonality point of view, we always have a bigger impact in the fourth quarter when it comes to engineering income. In this quarter, we had more impact than normal as we had additional reimbursement done for engineering costs that has been spent during 2019. So when you see the net number for the fourth quarter, that is not reflecting a kind of a normal run rate due to the engineering income, and in this quarter it's more than normal then. But saying that, we have had the sequential reduction in the gross RD&E cost every quarter since the second quarter. So you have both sides contributing. Looking into 2020, what we can foresee is that what we are kind of working with is to reduce the cost base and reduce the gross cost in 2020. But on top of that, we are also expecting some additional contribution coming from reimbursements of the higher engineering spend for certain customers. So it's a combination. But due to the intense launch period in 2020, we also need to kind of be prepared to have the engineering resources needed to handle launches. But saying that, we are still targeting a reduction of the RD&E in 2020.
I think it's also worth to add here that if you look to the higher than normal engineering compensation or engineering income Mats is referring to, we have also spent more money gross on engineering to prepare for all these launches that we are talking about. So it's somewhat communicating somewhat higher engineering income, but also significantly higher engineering spend during the year of 19.
Okay, and just to follow on, could you frame up the transition headwinds from the radar bandwidth shift to 2477? How much was the headwind in 19? What's expected for 20, and even beyond that, kind of when does it sort of become a tailwind?
Yeah, I mean, we will continue to have a headwind when it comes to this the shift in technology in the first half of 2020. But then, as you saw at John's slide, when it comes to launches, you could see that the new technology in quite a lot of those launches, so it will gradually improve then in the second half of the year.
We will believe that this should be over by after 2020. So it will abate during the year and be over by year end to the highest extent.
Okay, thank you.
Thank you. We will now take our next question from the line of Erik Golrang from SEB.
Thank you. I have two questions. The first one, coming back to the previous one there on the order trends. I didn't fully get everything you said. Did I read right that around you lost around 600 million of orders in 19 compared to what you originally targeted, and that 50% of that, or 600 was pushed into 2020, and that 50% has been lost of that, and 50% still up for grabs. Is that correct?
Some of it has been awarded, and some of it has been lost, but we say that the ballpark half of it still remains for grabs.
Okay, thank you. And then the second question, also coming back to previous topic on RD&E spend, would you sort of make a stab at saying what the underlying annualized RD&E spending is in Q4 for the core business, i.e. excluding brake systems? Q4 on an annualized basis for the core business?
Yeah, I mean, as we are guiding now for 2020 of the core business together with the U.S. operations when it comes to brake control. So the comparable net number, looking at the net RD&E, that's 537 million.
Okay.
To give you the right baseline, and then what we're saying that we are targeting an improvement from that level in 2020.
Okay, thank you. Then the final question on, the order delays you experienced in 2019. Do you see that, or the factors behind that as stabilizing now, meaning that there's less of a risk that we get further delays in ordering activity?
I cannot say that. I think this is a very fluid situation, and it's a lot of discussions, and it will be probably more discussions throughout the year. We, of course, have seen this happening in 2019. We are trying to make our best estimate what we can win here in 2020. But that it's stabilizing and getting more easier to forecast, I don't think I can say that. It's still volatile.
Thank you.
Thank you. Our next question comes from the line of James Piccarelli from KeyBanc Capital Markets. Please go ahead.
Hey guys, just digging into the guide specifically for the first quarter. Are you expecting both sales and EBIT to be down year over year and sequentially? Or is the commentary in the press release just tied to sales?
Yeah, I mean, if you're looking at the outlook as we are describing, I mean, we will year over year. I mean, it's definitely a negative organic growth in the first quarter. And then,
what about for EBIT?
Yeah. And what was the second?
Oh, just regarding operating profit for the first quarter, is that also expected to trend down?
Yeah, I mean, look, if you're comparing to the fourth quarter, and again, from a seasonality point of view, the fourth quarter is always the strongest quarter from a seasonality point of view, very much due to the engineering income effect that we see every year in the fourth quarter. So sequentially, it's a negative development into the first quarter, yes.
Okay. And then maybe just to ask the RD&E question another way. In the fourth quarter, you cut 180 employees. Do you expect additional cuts through 2020 in terms of your targeted headcount reductions, or are you about done?
Well, we are looking into different type of activities to improve our efficiency in RD&E, and to the extent that it's going to affect also the headcount. It's primarily a cost focus and efficiency focus where we are looking to work with partners, and to what extent that is also going to affect the headcount number. I'm not going to speculate at this point in time, because it's also how the cost base for the resources that we have will be applied when we are coming further down the road in the year.
Got it. And just one clarification regarding the 2022 framework. So you're targeting $2.5 billion in sales. You specifically call out active safety revenue to double, which would imply $1.4 billion roughly. So the implication there is that restraint controls then surpasses the $1 billion mark. Has the growth trajectory for RCS improved when looking out to 2022?
If you look to overall the growth trajectory, we will see growth in RCS business as well. But as you know, the RCS business is a business generally that is developing with the market in line with the light vehicle production market. So the growth coming from for us coming in RCS is coming from better order wins over the last 3-4 years than we have seen in the past or before that.
Okay, thanks guys.
Thank you. Our next question comes from the line of Joachim Gunell from DNB Markets. Please go ahead.
Yeah, thank you. So just to start off here, with customers apparently postponing some of their investment decisions, what are your view in, say, the next 2 years in terms of OEM adoption of ADAS technologies on a more, say, broader scale versus being more of a comfort features for premium OEMs?
We see a good adoption rate, and as we alluded to in our formal remarks here earlier, we believe that our part of this industry is continuing to see growth. It's driven by legislation, it's driven by Euro NCAP requirements, and the sharpening of the Euro NCAP requirements step by step in many parts of the world, and this is driving the features and the content of the vehicle. So we believe that in the world of stress in the automotive industry, we look to see a further improvement of our markets.
Lovely. And finally, regarding the growth profile in the U.S. operations of brake systems, I mean, there's a larger contract ramping up there, I assume, but are there anything you want to mention in terms of the growth profile in the U.S. operations as opposed to the Asian one?
No, not really. We have commented a couple of contracts there to a global OEM in the U.S. We have a strong focus in launching this. It will launch later on this year, the first part of that contract. As you know, we have the brake systems under strategic review for the time being. We are guiding, as this is a part of our company and a strong focus to launch the commitments that we have. We are guiding, including these brake systems, but I have no other comments to give besides this for the future. We'll come back to that later throughout the year.
All right, thank you.
And our next question comes from the line of David Leica from Baird. Please go ahead.
Good morning. This is Erin Wilson back on for David. My first question is about the market share of your new contract awards. I guess I'm wondering, where are you winning the most new business from a market share standpoint, and maybe where is market share trending a little bit weaker, and how does this compare to kind of the prior year periods?
Well, if you look to our market share wins, even in 2019 with a lower than expected order intake number, we won more than our market share for 2019. So pointing to that, it's a better win than our market share. We definitely see wins in all product areas. I would say we see wins in vision, as we announced here. We see wins in radar. So we are gaining business. I cannot point in all of our product areas. I cannot say that we are any product areas that is lagging behind particularly. We are seeing new technologies being launched, as I mentioned also in my remarks here, that should improve also our prospects for the future down the road.
Okay, and then my second question is just with respect to your confidence in the revenue ramping conversion to profits. You know, for others, this has been challenging converting the book of new business profitably. So any comments on that?
Well, this will correct itself in the overhead numbers and the overheads in relation to sales. Then returning to profit will gradually improve down the road when we are ramping up the sales number. This is a challenging market, and it requires a lot of upfront investment. So over time, we expect the numbers, of course, to normalize. We have not given any outlook on 2022. We gave the sales outlook, but not any profit numbers or any other indications of normalizing R&D in relation to sales or becoming profitable or so. We'll have to return to you with that at a later stage. But we expect a growth in 2020. We expect that to accelerate in 2021 and in 2022, and gradually then this will normalize.
Great. Thanks for taking my question.
Thank you. Our next question comes from the line of Johan Andersson from Danske Bank. Please go ahead.
Björn Enarsson, Danske. I have a question on the U.S. brake business and also the financial implications from the divestment of the Asian part. If you can help us out with some further clarification and how we should look upon the brake
business in the P&L in the first half, if that's possible?
Yeah, I mean, first of all, you need to separate the U.S. part and the Asian part, because I mean, the part that was divested now, that was the joint venture for Asia with the net proceeds of 170 million. But the U.S. part of it is still in, and it's also included in the guidance we are giving them. So I mean, the baseline is really our core operations, meaning active safety together with RCS. And plus the U.S. brake operations. So that's the baseline.
And then maybe just, Thomas here, maybe just for the historic comparisons, you can also look at the full year segment report in the press release on page 5, where we provide a little bit of commentary on the historic sales and the RD&E on the Asia part, which I think helps get you some reference numbers.
And the cash impact has happened now?
Yes.
A couple of days ago, yeah. Okay.
Yeah.
Perfect. Thank you.
Thank you. And our next question comes from the line of Joseph Spack from RBC Capital Markets.
Thank you. I wanted to head back to the comment about the orders and what's sort of up for grabs. I guess just to be clear, are you seeing some more competitors on a portion of that business bidding for that business than you sort of previously assumed, or it's a little bit unclear to me sort of what changed on the part that sort of hasn't been awarded yet?
Yes, we have seen some competitors coming in here. This is a evolving technology, and we have seen actually new companies bidding for business. Depending on what type of business it is, we can see new competitors we have not seen to a high extent, at least in the past, coming in. And that is related to the active safety piece. On the RCS business, we don't see any new competitors, but on the active safety piece, we can see some of the new competitors. I also wanted to make a clarification here to the question I think came from Erik Golrang. You mentioned the number of the 600 million being pushed out, and then you said half of that being or something. We have not quantified how much of the total delay that is pushed out. We said that the majority of the gap between the number we indicated of between $1.1, $1.2 billion and the 550, majority of that gap was delayed. Not to have any mixes about quantifications around how much of is up for grab or so. We still see what we defined being delayed. We still see half of that being up for grab. Just to be quite clear to not confuse everyone of the specific numbers.
Okay. And then I guess the second question, just back to the R&D. I mean, I know the fourth quarter is sort of not the right run rate, but I guess just more broadly, and as you think out here over the next couple of years, how do you think about the R&D spend and either growing that or maintaining that, relative to sort of the ambitions to sort of, grow the top line, right? Because there's an element of the RD&E, right, that's sort of gonna, have to go higher as some of that business sort of comes to launch. But then there's also an element that, I guess more on the R side and D side than the E side, which is, to sort of keep pace with the industry. And I think, if that's starved somewhat, then it seems like there's a corresponding impact to the top line growth.
No, when you're looking at the RD and E, the majority is on application engineering, very much driven by the order intake and the pre-launch and launch. Meaning that if you're looking at more on the R side, that's not where we are cutting down. It's more on the application engineering side. And what we have done now in 2019 is to, recruited quite a lot of engineers back in 2018 and into the beginning of 2019. So what we have been talking about is more efficiencies and consolidating the base that we have. And I wouldn't say that we are kind of risking any business from doing that. So when we see the run rate right now, that's more of a kind of a consolidation and efficiency gains we see. And then, as Jan said, now we can look into the kind of the next step of what we can do together with partners and so forth going forward. But that is still without jeopardizing the growth, I would say.
But then just to be,
we have a skilled set of people here and a lot of good engineers. What is important is that we use them efficiently for what is unique for us and our algorithm development, our architectural development. Repetitive work of standard type should be preferably used with partners. Things that can be reused and redone in application engineering that Mats is talking about here could preferably be done outside.
But so if the the best sort of indicate if the RD&E is sort of more tied to sort of order intake, then then as that comes online and converts to revenue, it seems like the RD&E should also increase. I guess I'm just wondering, like, and maybe it's difficult to sort of put a fine point on it, but like, when do you actually start seeing some of the greater leverage on that spend? Because it would seem like you would actually need a couple of years of that higher revenue to sort of really overtake the RD&E to sort of support the order intake. Is that fair?
Yeah, but I mean, in terms of leverage, I mean, if you're looking at the indication for 2020, when we are saying that we will, what we are targeting is to reduce the RD&E in absolute numbers, and we are talking about an organic growth. I mean, the relative RD&E will start coming down, and you will see some leverage coming through that. But it's also, I mean, what we have done, and when we have reduced the run rate and where we are right now, we also need to remember when we're looking into 2020, and again, referring to Jan's slide, I mean, we have 5 huge launches now coming up in 12 to 18 months. So we also need to be prepared for the launches, and we need to have the kind of the resources in place then. But I think even though you see growth and you see order intake, I can't imagine that we will have another 12 to 18 months period with those kind of new technology launches with this size. So it is a little bit of a perfect storm looking on where we are today.
Okay. Thank you very much.
Thank you. And our next question comes from the line of Olga Nisko from Nordea. Please go ahead.
It's Agnieszka Vilela, Nordea. I have a couple of questions and follow-ups, if I may, please. Starting maybe with the R&D and your guidance when you guide on the comparable basis. Can you just be specific and tell us what the comparable basis for R&D was in 2019, so excluding the brakes Asia? Thanks.
537 is the baseline. Net RD&E full year 2019, excluding the joint venture.
Okay, thank you. And then also, if I calculated correctly, then the U.S. brakes business in 2019 contributed with 60 million in sales. And my question here is, what's your expectation for the kind of cadence for the revenue growth for brakes U.S. in 2020, as you included in your organic growth guidance? Thank you.
I mean, we have, and coming back again to what Jan said, I mean, we have one of the big launches all related to the brake controls, but that is in the later part of the year, 2020. So it's not a significant impact on the organic growth guidance for full year 2020. The bulk and the majority of the growth are coming from active safety, looking at the growth there.
All right. And then just coming back to active safety sales decline of 20% in Q4, I would appreciate if you could be a bit more specific about the headwinds coming from the shift in radars and also the BMW ramp down. Could you quantify it, and also could you specify when exactly these headwinds will disappear?
I mean, the majority, if you're looking at active safety overall, the majority of the decline, that's the radar business related to radar and the technology shift down. And if you are looking forward then on the change in trend, so to speak, that we will continue to see a negative impact in the first half of 2020, but then it will gradually improve, and you can say that into 2021 we start to get through the technology shift, so to speak, with launches and so forth. So it's very much related to radar.
Yeah, okay. But do you expect that the negative impact in H1 will be kind of double digits on sales?
You mean from radar alone, or?
Yeah, if it was the majority of the sales decline that was connected to the radar shift in Q4, and if you expect it to continue in Q1 and Q2, will it be as kind of severe impact year on year?
I wouldn't be that kind of granular looking on certain products and technologies. But first of all, the comps are getting easier looking into 2020 versus 2019, as we saw the same issue in 2019 then. But otherwise, I will just kind of stick with the overall guidance that we have, talking about a tougher first quarter and then gradually improvement and going into growth in the second half of 2020. Overall.
Okay, thank you. Yeah, thank you.
Okay, so just mention that we have 5 minutes left, and of course we intend to end on the hour, but we'll be available, of course, from Investor Relations after the call as well.
Thank you. We'll now take one more question, and this comes from David Kelly from Jefferies.
Hi, good morning. Just looking at slide 9, the average dollar content per vehicle of new launches, you referenced $270. I'm assuming that's comparable to the $175 in 2019 that you referenced on slide 13. Could you talk about the drivers of that increase? How much is product mix, or is this more tied to the expanding addressable market as your level 2 launches start to ramp?
It's affecting the level 2. It's affecting the number of feature increase. It's including and driven by increased ANCAP requirements and many different factors driving this forward. But as you can see from this, it's also including, as we mentioned, the brake systems that is a part of it. So many different factors driving behind it, and technology improvements and increases.
Okay, perfect. Thank you. And then a question on active safety win rates. You referenced the increased competition in the space. I guess could you provide some color on how you're converting the bid list, and are you seeing any considerable differences in win rates across product lines or changes in historical win rates as well?
No, I cannot quantify that. As we say, that when you look to our key components of our sensor suites and our airbag controllers and also our ADAS controller and our software suite, we are in a very good position. We are seeing a strong customer interest, and we expect this year of launches to prove that and to make it even more visible to customers of our development and of our product performance here, looking a little bit further down the road. We experienced that same step change in 2016 when we launched a previous generation of our sensor suite. Now we are coming out with a renewed product portfolio, and we expect that to happen. But as I said, and in this space, you see new entrants trying to come in, and you see people bidding on at least some of the product portfolios here, if not all of it, but some of it coming in. And that is expected. We have expected that to happen, so I don't think there is any change from our previous opinion.
Okay, great. I appreciate the color.
Thank you, and we'll no longer be taking questions. I'd like to hand the call back to Jan.
Thank you very much, Summer. I would like to thank everyone for your participation, for interesting questions as of today. And we, of course, look forward to seeing you on conferences and roadshows, etc., during the quarter here. Our next quarterly earnings release is planned for end of April, and we will revert back to you with the exact date. We are also intending to hold a business update more generally in between our earnings releases in the end of late spring or beginning summer, and be back to you with more color on that one as well. So until then, I wish you all the best, and hope you are having a good start of 2020. Thank you very much for attending today's call.
Thank you. That does conclude today's conference. Thank you for participating. You may now disconnect.